Markets tumble as consumer spending fears gain traction. So markets have fallen over 3% in the last four market days as consumer confidence fears fester. It started with Walmart's weak retail sales outlook for the year on Thursday, and then began to snowball with Friday's weak consumer sentiment data, and then today's consumer confidence. So first, let's take a step back. Consumer sentiment? Consumer confidence? Well, both are essentially surveys conducted to gauge how consumers feel about the economy and their financial situations. The Consumer Sentiment Index is conducted by the University of Michigan, and the Consumer Confidence Index by the Conference Board, a nonprofit think tank. So the sentiment index dropped first last Friday, with the overall index falling pretty significantly by about 5% from January. This surprised investors not really expecting any change in the sentiment. Then today's Consumer Confidence Index showed a 7% drop from January. It was actually only expected to be down 3%, which likely means forecasters thought Friday's consumer data skewed a little too pessimistic. But it came in even worse. So markets quickly pulled back from all-time highs last Wednesday. So why is this important for stocks? Well, consumer spending drives a large part of the economy. As we've mentioned in prior videos, consumers have been incredibly resilient despite the surging inflation. Consumers have been coping using savings and credit card debt, but need some relief to continue. Of note from the recent consumer data, consumer expectations for future inflation has spiked in the past month, and likely a large factor in the deteriorating sentiment. Of course, remember, this is just survey data, not quantitative results, and may be more emotionally biased. However, regardless of the accuracy of the expectations, consumer sentiment is still likely to play a role in a household's spending plans. That's what's concerning for markets. Investors have been banking on a soft economic landing, meaning the high interest rate slows down the economy enough to curb inflation, but with enough time to reset back to more balanced rates before the job market collapses and we slow down way too much. If consumer confidence erodes and spending pulls back just as sharply, that could end up tipping the US into a recession. Obviously, we'll be keeping a close eye on it for any new consumer data as we head into March.